and exceptional 45% increase in the net profit, which is at 817 million. And if you recall this number, 817 million was the net profit of the full year 2024. CapEx is on the level of 150 million, more or less, and this will be increased to the level of 300 million after the closing of the acquisition in Uzbekistan. Free cash flow increased to 241 million SARS, and we are still with a very low net debt to equity ratio of 0.16 multiple. Moving to the backlog, we are holding 162,000 tons of confirmed orders, which are equivalent to 5.2 billion of reals, and we will be discussing this in a dedicated slide later on. Showing the key performance drivers, we can see that the sales volume has increased, backed by an excellent export and very strong transmission, both in domestic and export markets. In the next point, we can see that solid demand-driven revenue also increased by 22%. In fact, the performance on, again, domestic market, together with the excellent export and very good as well market for all segments, we have witnessed in these 9 months. Let me say that in the Q4, we may see some slowdown in local utility, but this happened as well last year. It's a kind of seasonality, and as always, any gap we will try to recover with other customers and other channels, and mainly by export as well. Gross profit per ton increased by 19% as a result of mix and cost efficiencies, and surely as well a very good effect of the high utilization of 97% of utilization of our lines. Net profit increased by 45%, backed by strong operating income and firm control on overall cost. Again, G&A and S&D are below 3% of our revenue, which is always our target of the cost efficiency. Free cash flow 241 million. As promised, the cash generation accelerated this quarter from 61 million of the previous quarter. This is as well thanks to good control of working capital. Moving on the slide number 10. Quarter on quarter, we can see the revenue is pretty much the same, with a slight volume increase of 3%. This is mainly due to a small mix effect, let's say, within the copper products. 9 months to 9 months, instead, the volume is higher by 22%, while the revenue increased by 20%. As mentioned, the market remains solid, both domestic and export. Generally, all segments are doing quite well. With regards to the split between copper and aluminum on the 9 months basis, we see an increase on aluminum product split, while on quarterly basis, the split remains exactly the same. Moving to the slide 11, we can see the backlog of 5.2 billion and the volume of 162,000 tons, slightly down from the first half, but above from the Q1. So still a very good, solid backlog of confirmed orders in our system. And on top of this, we are having as well quite good level of letter of awards, a letter of intent above 2 billion real, which gives us again a certain degree of comfort of the solidity of our future performance, domestic and export. The backlog will be realized in 6 to 12 months, and the strong demands, again, as mentioned before, are pushing our utilization rate on a high level of 97%, which level we also brings very good operational efficiencies. Now I hand it over to Baha for more financial highlights. Thank you.
Thank you, Boris. This was another great year for Riyadh Cables, leading to an excellent performance in Q3. 9-month gross profits has increased by 38% to Saudi riyal 1.3 billion compared to the same period of last year. This came on the back of higher sales figures, as Boris mentioned, which were up 22% to 7.9 billion compared to the 9 months in 2024. In addition to the increase in quantities sold by about 20%, which were 204,000 tons during the first 9 months of this year. Also, these results were helped by order selection process, our production mix, and continued efficiencies. Comparing Q3 25 gross profits to the same period of last year, we achieved an increase of 11% to Saudi Riyal 446 million. Moving on to EBITDA, which has increased by 37% to 1,007 million, 1 billion riyals during the 9 months of 2025, compared to the same period of last year. This was driven again by higher volumes and selection methodology and cost control. And when looking at the quarterly performance, quarter 3 EBITDA did increase by 19% to 354 million, compared to the same period of last year, which was 299 million. Moving on to the sort of cash flows. Again, good results. Cash flow for the 9 months stood at 241 million riyals, while operating cash flow was 388 million. This was driven by the strong profits and provisions. And as mentioned, as Bori mentioned, this was increased from the previous quarter, which was 61 million riyals. As far as the dividends, the company has paid 300 million in May 2025, which pertain to the second half of 2024 profits, and also paid another 300 million riyal in October of this year, which pertain to the first half profits of 2025. And again, from this, all of these were paid from its internal sources. H1 dividends, just as a reminder, H1 dividends was Saudi Riyal 2 per share, and this is up by 33% over the same period of last year, which was 1.5 riyals per share, or a total of 2025. These results continue to support our declaration that the company is always aiming to fund its operation, including capex and dividends from its own cash flow. Moving on to the profitability per ton. As previously stated, our hedging and pricing strategy does neutralize commodity price fluctuation. From the charts that we're looking at, we can see the gross profits per ton continued this upward trajectory, and for the 9 months of 2025 has improved further compared to the same period of last year by 19% to Saudi Riyal 6,393 riyals per ton. Again, this was achieved through continuously improved pricing policy as well as better product mix, which is mainly focused on the transmission cable operational efficiencies due to higher utilizations, which have reached 97% for this period. Further improvements in production lines and vertical integration did contribute to these results. The bottom chart shows that regardless of where the metal price is, our profitability has not been impacted by its movements, since it is always calculated as an absolute number that we slap on the selling price. If we look at the average copper prices over the past year, we can see that the fluctuation has been quite substantial, ranging from $8,500 per ton to over 10,000. And again, there was no impact on profitability on this. With that, I'll pass it on to my colleague, Munez.
Thank you, Baha.
You're welcome.
So here's a refresher on our strategy that continues to center on 5 key pillars. We're deepening and expanding our geographical footprint by strengthening our position in KSA and core GCC markets, while entering high growth regions such as Central Asia, the Levant, and North Africa, ensuring leadership in every market we serve. We will share more details on our recent acquisition in Uzbekistan and latest developments in Syria in the next slides. Through product and service innovation, we continue to evolve to a complete cable solutions provider, offering integrated systems that support energy transition. We have completed testing common medium voltage accessory sizes at third-party labs and received our first orders. Operational excellence underpins our cost leadership as we continue to enhance efficiency. We optimize our supply chain and leverage digital transformation to maintain our competitive edge. At the same time, we are investing in our people and processes to build a high-performing, agile organization capable of sustaining long-term growth. Finally, we remain firmly committed to ESG principles, gradually embedding sustainability and social responsibility across our operations to ensure responsible value creation for our stakeholders. In this slide that you're very familiar with, we are providing an overview of RCG's key operating markets, which collectively account for approximately 95% of our total revenues. During the third quarter, market demand remained strong, with Saudi Arabia continuing to be the largest contributor, accounting for around 71% of our total volumes, followed by the UAE and Iraq. Overall, the market maintained a steady pace, broadly in line with levels recorded in the second quarter of 2025. In Saudi Arabia, volume growth continued to be driven by momentum in core demand sectors, including giga and mega projects, infrastructure projects, renewable energy developments, transmission network expansions, and large-scale housing and real estate programs. In our export markets, particularly across GCC and Iraq, performance was in line with expectations, maintaining levels similar to Q2 2025. This was supported by ongoing infrastructure investments and utility projects. In Africa, performance was notably strong, showing a significant improvement compared with the previous quarter. We continue to maintain a market share around 38%. Regarding our outlook and based on internal market intelligence, third-party research, and current backlog visibility, we project the market growth rate between 2024 and 2028 as follows: Saudi Arabia around 5%, GCC slightly above 3%, and then Iraq about 9%. As we have accustomed you in previous years, we will conduct our annual market study towards year-end, and we look forward to sharing the results along with our updated market outlook during the year-end call. As mentioned earlier, here's an update on our acquisition of a majority stake in Article Asia Cables. This is an Uzbek company. On October 27th, Riyadh Cables Company, a subsidiary of Riyadh Cables Group, signed a share purchase agreement and a shareholders agreement with the existing shareholders of Article Asia Cables that we're going to refer to in the rest of the call as AAK. The transaction value is approximately 143 million Saudi riyals. The deal is currently under review by the relevant authorities, and we expect closing to take place during December. As far as the company, AAK was established in 2014 by a local entrepreneur family in Uzbekistan. Since its founding, the company has focused on manufacturing electrical power cables and copper rod. Over the past decade, AAK has evolved into a significant regional player in the power infrastructure sector. The company manufactures a wide range of overhead and underground power cables up to medium voltage cables, in addition to copper rod. With over 3,000 SKUs, AAK is able to meet diverse customer requirements. Its manufacturing footprint in Uzbekistan boasts a max design capacity of 20,000 metric tons annually, supporting both domestic and international demand. In 2024, AAK's revenues stood at 407 million Saudi riyals with 13,000 tons of sold volumes. Between 2022 and 2024, the company achieved a compound annual growth rate of about 20% in revenues. Both EBITDA and net profit margins are in line with RCG's averages, reflecting strong operational performance and disciplined cost management. AAK generates 60% of its revenues from exports, serving approximately 17 countries. The remaining 40% comes from domestic markets, where the company holds about an 11% market share, servicing a variety of sectors, mainly utilities, mining, industrial, commercial, and residential construction projects. As far as the rationale behind this deal, we want to give a quick overview about Uzbekistan market itself. Uzbekistan stands out as one of the most dynamic energy and infrastructure markets in Central Asia. Driven by rapid industrialization, along with a strong metal mining base, notably copper and gold, and strategic export corridors linking Europe and Western China. The Uzbek government continues to advance an electrification and throughput expansion agenda, underpinned by major financial and operational reforms designed to attract investment and enhance local value creation. These include local content preferences, raw material incentives, and mandatory procurement lists for government and semi-government projects, all of which foster in-country industrial development. This is a strategic fit for RCG. It is a partnership that represents a strong strategic fit for Riyadh Cables Group on multiple levels. First, AAK offers a compelling investment case. It is a growing company with a solid industrial base, diversified revenues, and a scalable manufacturing platform. Its strong local presence and export potential align perfectly with RCG's long-term regional expansion strategy. Through this investment, we're not just entering Uzbekistan, we're gaining a strategic platform to serve Central Asia, Europe, and the Middle East markets, especially as new interconnect renewables, and grid expansion projects come online. On the operational side, both revenue and cost synergies will be realized. We will be introducing RCG's procurement, operational, and engineering systems, refined over decades in our Saudi operations, obviously, to drive efficiency, quality, and cost optimization. In parallel, our technical know-how in high and extra high voltage cables and complete cable systems will be introduced to AAK. This will raise production standards, secure product qualifications, and align their output with RCG's global benchmarks. AAK today manufactures low voltage and medium voltage cables and building wires, and we will now help AAK move up the value chain into high voltage and extra high voltage and renewable energy cables, all of which are currently imported into Uzbekistan. This shift will open up higher margin segments and make AAK the leading local supplier for power and renewable energy projects. Financially, the investment is structurally conservative, or it is structured conservatively, phased capital deployment with limited balance sheet impact and consolidation effects starting in 2026. Finally, Uzbekistan provides a secure long-term advantage in copper sourcing. It is among the top 20 copper producers globally, with expansion plans that will increase national output to over 400,000 tons by 2030. This ensures stable raw material supply and supports AAK's growth for years to come. Overall, the partnership is not only a sound financial investment, but also a strategic step forward, expanding RCG's regional footprint, employing our know-how, and creating a stronger, more competitive manufacturing hub serving Central Asia and beyond. Moving back to our region and a bit north, we'd like to provide a quick update on the company's recent progress in the Syrian market. This is a market where Riyadh Cables Group had established a presence years ago prior to the sanctions period, and where operations are now gradually resuming. As many of you know, Syria presents meaningful opportunities for RCG to meet the growing cable demand expected over the coming years, particularly as reconstruction efforts and infrastructure rehabilitation gain momentum. In this context, RCG established a sales office in Damascus during the second quarter of 2025, focusing on marketing and selling our products. Our initial efforts have primarily targeted the government and retail sectors, where we continue to see steady demand for power and electrical cables. Most recently, we signed a memorandum of understanding with the Syrian Sovereign Fund, the current custodian of Syrian Modern Cables Company, which is a semi-dormant industrial asset. This initiative is strategically important for RCG as it aligns with our broader objectives of regional expansion, industrial localization, and technology employment. The future sustainable partnership offers strong operational synergies, combining RCG's manufacturing expertise, quality systems, and supply chain capabilities with the existing infrastructure and market access of the Syrian Modern Cables facility. Our close geographical proximity further supports efficient logistics, faster response times, and cost-effective operational support across production and distribution. Over the past month, our team have been working closely with the Syrian Sovereign Fund to define the technical scope, investment requirements, and modernization plan for the facilities. Early assessments are very encouraging, showing strong potential to revive production capacity and position the plant to serve both domestic and export markets in the medium term. While the initiative remains in its early stages, it underscores RCG's commitment to long-term value creation through regional partnerships, operational excellence, and sustainable industrial development. We will continue to update the market with any material developments in this regard. Over to you, Boyan.
Thank you, Boaz. Very exciting in seeing how we are realizing our strategy, building the growth on three main strategic pillars, which are, as you mentioned, geographical expansion, crucial for us in de-risking a single country or single region revenue. Second pillar, which is one of the strongest, I believe, as well, is technological leadership, which gives us as well an extra comfort in succeeding with our operational experience, bringing it to Uzbekistan and in Syria. And the last but not least, we still are the, let's say, cost leadership company, because the focus on cost is the priority to us, being always one of the most competitive, if not the most competitive cable player in any market. So these three strategic pillars are really the fundamental for us for our growth, and not only country-wise, regional-wise, and hopefully building as well a good leadership position in another region like Central Asia. And this brings us to the 2025 upgraded outlook. As you can see, for the second time this year, we are upgrading our guidance, increasing, let's say, to 30% net profit growth compared with the previous years, which take us to the level of 1,060 million plus riyals. To avoid any doubt, this is excluding any Article Cable Uzbekistan acquisition effect, as we will be consolidating this new business, new acquisition, most of it next year. We also confirmed the CapEx to be in the range of 300 million as our initial guidance, of which 120 million this year will be effect for the part of the Uzbekistan acquisition. In conclusion, we hold a very strong, very solid, let's say, backlog with very good mix and pricing. Moreover, in the kingdom and in the region, the macro trends are still strong. This is very good news. And the growth that you are doing in export, in addition to geographical expansions, this will surely help us to have an even more solid view for 2026. This is the end of our presentation. I believe we can now start the Q&A session. Thank you.
Thank you, Boyan and Boaz. So we can now start the Q&A session. Everyone, you can send the Q&A in the Q&A box, or you can use the raise hand function and we can unmute you to ask your questions directly. We'll start off by the raised hands. Khalid, please go ahead. Your line is open.
Thank you, management, and thank you, EFG, for organizing this call. My first question is on this quarter's OpEx levels. And we saw a continuation of somewhat elevated OpEx levels. Did this stem from higher SG&A, or did we have another ECL this quarter from Iraq?
Sorry. No, it came in firstly more efficiencies during the period.
Sorry, I think the first part of your answer was muted. My question was regarding sort of the higher OpEx level. Was this from sort of ECLs or?
The higher OpEx, there was an increase in the ACL, yes.
Could you elaborate more into the Iraq project and how what's the status of the receivables for the project?
The receivables are still under control. I mean, it's still within the same periods that days receivable that we have in the past. We're not seeing any major slowdown. There might be a bit of a delay, but overall, it is under control. The receivables, it gets to be paid, within the time frame that we do expect. So we're not really seeing much deterioration in terms of the quality of the receivable.
And Baha, could you just give us the exact number of the ECL for this quarter?
Just 1 second. ECL for the quarter, for this period, for the 9-month period, was 240 million. And there was an increase of 28 for the third quarter.
Okay, so the last 9 months or this quarter, we had 28 million in ECLs.
Yes, an increase.
Okay, and then when can we expect reversals to come in from the Iraq project?
Sorry?
Can we expect any increased ECLs going through the fourth quarter, or are we confident in any reversals until the end of this year?
No, we do not expect any deterioration, as I said. And mind you, I mean, the ECL is calculated based on a formula that takes many factors into consideration. One of it is also, the movement on the receivable. But we do not expect to see any deterioration compared to what we have seen so far.
Can we see increased ECLs as well going to the fourth quarter, or is this the?
Can we what?
See further expected credit losses going to the fourth quarter?
We do not have credit losses. Let's be clear on this. What we have, these are provisions that are created just in case, and this is as per IFRS rules, using a specific formula that we do follow.
Okay. And if we can, I think Brian just mentioned earlier on the backlog page that we have 2 billion in LOIs. Is this included into the 5.2 billion number that was mentioned, or is this?
Yes, let me answer, Boris speaking. It is not included. It will be on top of the 5.2 billion. So it's just a very much similar number in average. If I take the Q1 backlog and the LOIs and H1 backlog and LOIs, this is in average, let's say, between the 2 quarters. So very solid backlog and very solid LOIs. And to answer about the ECLs, we are, as maybe you did not hear properly, but we are not expecting any significant ECLs movement in the next quarter. We don't have any risk. This is very important to mention. I need to stress this point. We don't have any risk of the losses. These are, of course, ECL expected losses according to IFRS. We will never do any business if we have any risk on losses. So let me simplify it in this way. We have one customer, which is a utility government customer, and everything is very safe. It is just a little bit delayed in payments, as we know. Nothing no surprises here. And we are deciding to continue doing the business because let's say the business is good. We know that receivables will take, in average, a couple of more, let's say, months than other normal customers, but there is no any risk. Every cost, all the costs, financial cost is included. And Alhamdulillah, being very strong financially and from a financial solidity point of view, we are one of those companies who can allow ourselves to make business with a good profit, including all these costs, and still serve one of the customers where we are growing, because we are growing the business. That's why maybe we have some ECLs increase, but this is the level we are expecting, and we are forecasting as well, hopefully for the next year, this level of ECLs.
Thank you, Brown. It's clear. Just further on the backlog. Globally, we see high voltage players having increasing backlogs up to 2 and 3 years, while RCG is at 6 to 8 months. Could you elaborate more into that? I mean, the structural fundamentals of the market is changing globally, including in Saudi. Why do we have
Very good.
this lower backlog?
Very good question. Very good question. The backlog internationally, yes, you see it covered between 2 or 3 years, even more, especially in the transmission projects. And I can tell you that UAE is the same as any other, let's say, most of the countries outside Saudi Arabia. Saudi Arabia is a little bit different. Saudi Arabia is the country where you need to take, let's say, an average planning, where the volume comes and the demand comes faster, very fast, and where you need to be prepared for this demand. Why nobody can succeed in Saudi Arabia if not a healthy Saudi companies like Riyadh Cable Group? Because when your utility calls you and needs hundreds of kilometers the month after, and this happens, we must deliver it. When utility comes and we sign the contract for 9 months, 6 months delivery, we can afford and we can be fast in our deliveries. Because Saudi, especially local utilities, normally they plan in a very short period. They don't plan in 2, 3, 4 years time. They plan within the budget of the year, financial year itself. And it's important to understand. That's why we have multiple lines. That's why we have flexibility. That's why we always want to have other segments to be dynamic, because this is the key of the success. Not to rely on one, but when local utility gives us a short term, even for the transmission projects, we deliver. And other utilities outside Saudi, usually the delivery time for the transmission projects are 18 months, 30 months, 36 months, even 48 months. We had one project a few let's say, quarters back, almost 4 years delivery. But Saudi is different, and you need to be equipped for Saudi. That's why none from outside Saudi. And if you are a Saudi company and you are not strong from capacity point of view, inventory point of view, speed, you will not succeed in Saudi. So this is in our DNA since multiple decades, and this is the reason of our success in Saudi. Saudi, in a nutshell, is a little bit different from others.
Thank you, Bahan. I've got two questions, if time allows. First, we saw in the transmission sector, in the transformers, EIC winning a long-term framework agreement. Is there anything similar for cables, or is it, as you say, it's more agile and shorter planning period?
We have as well framework agreement with utilities. This is the standard practice, especially for distribution and some transmission products. These framework agreements are normally, let's say, of the tenure of 12 months, 18 months. But important is, in our backlog, we don't have the framework agreement potential theoretical value. In our backlog, we are putting only the purchase orders, which are the call-off of this framework agreement. Understand? So we have the framework agreement, multiple framework agreements signed for multiple products with the local utilities. These usually are 1 year, can be extended another 6 months, and then of course new tenders coming from new framework agreements. So this is normal practice. We don't disclose the value of the frame agreement because it is on the paper. It is a theoretical value that, alhamdulillah, until now it is always withdrawn by the customers. What we put in our backlog is the real purchase order released and metals booked. So this is the certainty of that purchase order will be delivered within certain time of which is then defined in the framework agreement.
Keeping in mind that these framework agreements are a single-sided commitment from our side to deliver. It's not a commitment from the buyer to buy. It's just to make sure that we plan for it, and the deliveries or the way they call off these orders varies from 1 year to the other. So a good rule of thumb is what Borjan had mentioned, but depending on the performance of the utility, it can vary year to year.
Thank you. And just one final question from my end. With AAK, revenue stood at 400 million. You mentioned we have a similar margin profile as the company. Would we assume net income margin of 10% for AAK, or is this
I mean,
too
it's
optimistic?
similar as we mentioned. The percentages or the margins are in line with our averages as well. So I mean, I will not comment on the exact number. It's not disclosed information at this point. But you can assume the same percentages to draw up your models.
All right. Thank you. I'll leave some of my questions towards the end. And thank you for it.
Thank you.
Thank you, Khalid. We'll move to the next set of questions from Akash Kumar. Akash, please, your line is open.
Hi, good afternoon, everyone. Thank you for the opportunity to ask a question. Congratulations on a great set of results. Just two questions from my end, if you may. First is, can you comment on how the demand has been for you in terms of data centers? So are you in active contracts or tenders regarding data centers in UAE or in Saudi? That is the first question. And second is on the backlog. If you can give the split for backlog as of today, how much of it is in transmission, or how much of it is in distribution and for renewables? Thank you.
Yes, I will leave the backlog answer to Muaz. Let me answer the first question about the data centers. Data centers, the demand is coming. Requests for quotations are on our table. Surely this will be the trend for the next quarters and years to come. In UAE, we have already secured, let's say, a few transmission projects for data centers. Let me simplify a little bit what does it mean data center. Data center needs generation, needs transmission, needs distribution, and then data center is the utilizer, like a small city, using this energy. So it is. We are planning in Saudi approximately, I believe, 2 gigawatt of data centers by 2030. These are at least the numbers that has been disclosed. A little bit more of that will be in UAE. So it is somehow as well comparable to the solar generation, transmission, distribution, and then which electricity then is utilized by all ourselves and expansion of the cities. So to answer to your question, yes, we have secured a few transmission projects in UAE for data centers. This means that as well, medium voltage distribution should be coming soon, and we are as well ready to catch any opportunity within the data centers, which are in the end, let's say, wires, very much similar building wires and low voltage cables that we have in our portfolio to satisfy this demand as well. Will this drastically change our future demand? We are speaking about 1.9 gigawatt, 2 gigawatt 2030. If I compare this with 10, 15 gigawatt of solar generation, which is far from the cities, so you have much longer transmission, distribution, and gigawatts are 10 times higher, I believe that solar generation and renewable energy will still be one of the best, let's say, market demands in the country and hopefully in the region. Then, of course, on top of these, data centers will come, but with the gigawatt that I have mentioned before.
As far as the backlog, as it looks today, we're about 70% for transmission products, about 20% in distribution, and 10% in the end usage sector and renewable energy.
Thank you, Muaz, and thank you, Borjan. Just one follow-up, if I may, on the receivables question. So I do understand that it is more of a formula-driven thing, and it's not an actual credit loss. But if I were to look at for the first 9 months, this has been accumulating over the 3 quarters, but not once we have seen a reversal this year. There was a reversal last year, correct me if I'm wrong. There was a reversal last year in fourth quarter, but this year so far, we have not seen any reversals. So, I mean, how do we explain that? How do we contextualize that? Are we looking for a reversal anytime soon? Or because in the end, it is a provision that you are booking, it is a negative contributor to the earnings. So are we looking at some point in time a reversal for this, or is there something that I'm missing here? Thank you.
Thank you. Well, I mean, again, we go back to the to the fact that when ECL is calculated, it takes a number of factors into consideration. The aging of the receivable, the entity that it belongs to, the movement on the receivable itself, the economic situation and political situation in the region. So there are many factors that do take into consideration. Mind you, also our receivable has increased considerably during the period. We're looking at about 600 million increase in receivable. So once you take all these factors into consideration, it wouldn't be surprised. You would see an increase in the ECL.
Fair enough. Fair enough.
And we do, I mean, and there is still, mind you, payments are coming in for the receivable. So these are not statics, these are not standing, balances. We do see a rollover in the sense that old balances gets paid and, the new ones get factored in.
Yeah, by the way, receivables increase in absolute value because the sales increased. So, but in number of days, we are speaking about 4 or 5 days difference between this year and last year. 9 months period. So the increase in number of days of receivables is not relevant. Is not, I mean, anything more than 4 or 5 days as mentioned. Cash, we are generating cash. This is for us a very important point. So a positive free cash flow, able to finance from our own means any acquisition, any expansion, without having, let's say, any level of with the debt that we have mentioned before, debt on equity, is very healthy. So the machine is working, Arkash. The machine is working. About receivable ECLs, you always say that we are quite conservative here. If we keep the same level of business, possibly some reversal will come. But I believe it is time as well to increase some level of business with some customer with the better pricing. I see the opportunity there. And then, of course, ECL will follow up, but will follow down as well. As you mentioned, last year we have had quite good reversal of ECLs, which may happen as well in some quarter next year, but some other quarter I'm seeing it that will be again putting the ECLs up and down. So we can allow ourselves to do it. So this is and we are deciding this with our own decision. It is our forecast that we are having, and it is the decision that we are making in order to be strong into the market. And then you are right, financials are affected, but in the long term, the financial will be then affected positively because there's no any risk of receiving this money. It is just, instead of receiving in a few months, it is in average maybe 9 months receivable. So only for one customer.
Okay, thank you. That's a very fair answer, I would say, because as a percentage it is going down, but just wanted to get an idea on how do you think about it. Thank you for the detailed answer and all the best for the future.
Thank you.
Thank you, Akash. Our next question comes from Fraser. Fraser, please, your line is open. Please ask your questions. Fraser, can you ensure that you're unmuted locally as well?
Hi, yes, can you hear me now?
Yes, we can hear you. Please go ahead.
Great, thank you. My question really relates to the AAK acquisition, and I understand you talked a bit about the fact that you have similar levels of profitability. Could you maybe just expand on that definition of profitability? Are you talking about at what line of the accounts with respect to where you have similar profitability if the company's selling lower voltage wires and cables? And would you expect with the introduction of these higher voltage cables that will lead to, at a consolidated level, an acceleration of the gross profit per ton for the company, or it will have more of a marginal impact on the consolidated group? Thank you.
Sure, there are two things to note here. We had mentioned during the call that the government incentivizes the local manufacturers for local value-added industries, right? Especially the ones that are around the metals that are being mined in the country, namely copper and gold. So with that, the manufacturers receive some incentives on the raw materials. So the AAK is benefiting from that. This is one. The other thing is the company is one of four major producers or manufacturers of cables within Uzbekistan. So they have a good market share, and they're one of the only ones that manufacture medium voltage cables. If you went there 2 years ago, you'd find that there's not a medium voltage cable that's being manufactured in Uzbekistan at a large scale. Today, it's one of four companies that can manufacture medium voltage cables, and they're substituting all the exports that used to come to the country. With that, they're able, between the incentives and the local content, and being able to manufacture these higher technology products, relatively speaking, they're commanding good margins. Now, yes, the introduction of high voltage and extra high voltage cables and additional transmission products would help us in higher margins as well, or will give us higher margins once these products are rolled to the market. Keeping in mind that all of this is currently being imported, the government had enacted some laws and some decrees recently for local content mandates, especially on the cables and electrical products. I mean, some of these products have mandates for local procurement up to 70%. So, I mean, with that being the case, the government is trying to help the local manufacturers build a real cable industry within Uzbekistan with higher technology products as well, and then make it a gate for export as well.
Okay, great. Thank you. If I could ask one more question, if that's okay. I wanted to maybe ask about the competition you're seeing, not necessarily directly in the cables part of the business, but maybe more to do with the accessories or the slightly more peripheral parts of the business. I understand you've got someone mentioned company previously on the phone call, EIC have ventured into things like switch gears and that. How are you seeing competition evolve on maybe the outside of the more peripheries of your core offering, and how's that impacting the sort of bundling or kind of total solution package I think you've been trying to push and sell to customers?
Well, there are two things to separate here. First of all, as far as the high voltage and extra high voltage products, typically they're sold in systems, and whether we manufacture the accessories or not, we're selling them in systems. Our goal for manufacturing accessories and building these facilities is to complement our product line, especially on the medium voltage side. So the bundling and the packages might happen on the medium voltage side. How do we see competition? I mean, obviously, with us being able to provide a full system, we would have a competitive advantage over the ones that are either manufacturing cables alone or manufacturing accessories alone. What we had mentioned on the call today, as far as receiving our first orders for medium voltage accessories, I mean, this is pure accessories order only for medium voltage. For high and extra high, that product is still under development. It's not type tested yet, but we're selling somebody else's accessories meanwhile with our systems.
But Fraser, just as well to highlight here, the switchgear manufacturer or substation manufacturer usually is not our competitor, because these lots are separate lots when the utility like Skiko or Diwa or Taka make the tender. This is much separate lots from transmission part. Where we are growing and what was our, let's say, target and strategy is to have the turnkey projects. And here our competitors could be not cable companies, but maybe EPC contractors. But being the cable significant part, cable and system significant part of this turnkey project, again, we are quite competitive, and we can play a good role here for the turnkey projects. So we compete against EPCs when we have EPC project, and against cable companies when we have supply only projects.
Great, thank you very much, and congratulations on the results.
Thank you, Fraser. So we'll take our next question from Ahad Al Ahmed. Ahad, please go ahead. Hello, Ahad. Please ensure that your mic is unmuted locally.
Hello, am I audible?
Yes, you're audible. Please go ahead.
Yeah, thank you, management, for the call. Quick questions regarding your guidance for 2025 net profit. If I take the higher end, the 30%, this will imply like Q4 result to be lower by 3% year over year. Is this guidance conservative, or if you can just elaborate on this?
We believe that we will be on the upper level of the guidance. We mentioned 30% being 30, 31, 32. This is, let's say, the number that we are looking for quarter four. Quarter four, to tell you the truth, this quarter we have done 70,000 tons. Last quarter, 68,000 tons. First quarter, I remember 65, 66. So the quarter four normally is not the strongest quarter. Let me be frank, no? It will be surely better. We believe that it will be not the worst as well, because this is normally as well the case. Quarter four for us is an average good quarter. So we are forecasting 1.06, 1.07 billion of net profit, so 30, 31, 32%. This is the maximum stretch that we are forecasting.
Great. My second question on the, mashallah, the improvement in gross profit per ton. You mentioned the product mix, which is valid, but I have a question. Is the cables for transmission, the profitability are increasing, or it's purely product mix? And if yes, what is the reason for this increase? Especially with dealing with government or giga projects, they are kind of tight for pricing.
Yeah, our pricing, I believe, if you look at it is still quite strong, and the profit of the transmission are solid and higher if compared to other, let's say, low and medium voltage cables. So, and this is something that we are seeing also in the backlog. Now, if you see the mix of 2,000 tons more and only 15, 20 million more revenues, so these are, small numbers, which are some effect on the copper side, average selling price of a smaller conductor for some transmission cables. So, but this is just a small, small effect of the mix. So I don't want even to comment into these details. As you can see, the gross profit per ton is quite at the same level as previous quarter, means very good, very strong. Previous quarter, this quarter are the highest ever, and we, mashallah, repeated the same gross per ton for the full group as well this quarter, and hopefully this trend as well will be going in the future.
Now, if you allow me, for 2026 and onwards, 2027, would you have the same mix? Transmission sales will be strong, or we will see kind of normalization?
Transmission, we believe it will be quite strong, solid, because transmission, again, because of the interconnection, security, because of the solar, because of the data centers, because as well a lot of countries wants to interconnect in order to be safer and have this energy security in the future. Next couple of years, we know that as well we will be starting seeing Saudi as a hub of transmitting green energy outside Saudi, as well importing maybe energy from east and transmitting it to the west. All these trends, we mentioned these trends 2-3 years ago, and we got ready for these trends today, and today we are catching these opportunities, and we are seeing the same trends for the next years. So we believe that transmission will be still strong in the country, in the region, and worldwide for the coming years.
Right. I mean, if you look at the market demand drivers today, they're going to continue to exist for a while. Next year, according to some reports, it seems like construction, obviously, and the big projects are going to be the highest projects or the highest spending, followed by power and utility, and then the transport sector. So and that's going to be the case for 2026 and 2027, according to some reports. Still, renewable energy is going very actively, and with renewable energy, not only you're adding the generation capacity, but also you're adding the transmission capacity, along with the local within the kingdom interconnect projects are ongoing. I mean, some major projects to interconnect the different regions of Saudi Arabia are adding a lot of demand to transmission here.
Fantastic. My last question on your capacity expansion. How much of your capacity will add end of this year, the next year? Because mashallah, currently you are almost at the high end of the occupancy rates.
Yeah, this year was fantastic. No, if you compare this year compared to the previous year, 9 months, and inshallah as well full year, the growth on volume and capacity was excellent. Next year, our strategy was, of course, to add 6 to 10%, as we always say, year over year, and we will be forecasting together with the acquisition of Article Cable, Syria as well. Hopefully, we will be accelerating business there. This and some capacity expansions that we are finalizing here together with efficiencies. We believe we'll be following what we have promised, 6 to 10% more or less of capacity expansion and volume expansion year over year.
And how much have you added this year? Did you add the same number, 6 to 10%? Have been there any yeah.
Yes, I mean, generally speaking, yes. It's mainly focused on other facilities, not exactly completely in Saudi Arabia like we have done in the past couple of years. We're adding, we have some projects ongoing in UAE and some projects ongoing in Iraq. And then locally here, we have some scattered projects to mainly increase efficiency and add capacity by unlocking some bottlenecks within the plants. I mean, giving a number on it, it's not 100% complete yet. So I would say we're in the range of about 6 to 7% now with what has been added.
Great. Thank you, management. Thank you.
Thank you.
Thank you. We'll take a couple of questions from the Q&A box, which partly were actually answered right now, but just as a recap, we have a question from Saud bin Batal. What is the reason for the lower gross profit per ton in 9 months 2025 compared to the same period last year? Hello?
Yes.
This is specific for copper, by the way.
Yes, I see that it's specific for copper. I mean, it's mainly the product mix, you know, the different products that were sold over this period versus what was sold 9 months of last year. This year we have many products that are renewable energy related. These tend to be in copper. Last year we had some, but last year we had deliveries of higher deliveries, maybe of other products of copper base. So I mean, it's mainly the product mix, and keeping in mind that there was a lot of export products last year. We still see strong export with a different mix this time. So I mean, that plays into it as well.
Thank you. We have another question coming from Divya. The question is basically on guidance for top line 2025. And given that the current capacity utilization is north of 95%, what are you looking for going forward? I understand that you basically answered this partly, but if you want to elaborate more or add any more color.
Well, we forecast or we expect our growth to be in line with the market growth as far as the demand. I mean, the markets, the primary market we're in is going to grow at a 4% rate, give or take. Other markets would be between 3%, and for Iraq, about 9% is the expectation. So among these three, we would expect the growth to be about 4% rate, given that the same market conditions continue to stay.
Thank you for that. Now we have another hand raised. Khalid probably has some follow-up questions. Khalid, please unmute locally and ask your questions.
Thank you, management, and I apologize for taking your time more. Just a couple questions on the capacity expansions. So you said 6 to 8% as well going forward for next year. Can you touch upon where it's going to be? Is it entirely into AAK, or is it more Riyadh, Saudi, and high voltage, next high voltage?
To simplify, together with AK and Saudi expansion for the next year, the full RCG group together with AK will be on the higher level of that, let's say 8%, 8% plus, let's say.
Okay, clear. And if we, is it going to be new products, or is it the similar product and we're just expanding capacities?
Similar products and expanding capacity and capability of the similar products in order, let's say, more niche products as well, in order to catch opportunities or more, let's say, specialized cables here in Saudi, but as well as in UAE. And as Moaz mentioned, in Uzbekistan, we have great opportunity because the company in Uzbekistan has grown very well, as you have seen, the CAGR of 20+% year over year in the last 2-3 years, and they have reached the level that they needed a strategic technological partner in order to grow faster, because they have good lines, they have good capacity. Theoretically, they have good capability, but together with integration with our, let's say, know-how, technology, operational efficiency, we will be bringing a much better mix in the future in Uzbekistan, hopefully as well for the exports and opening the doors more and more exports country for the overall Riyadh Cable Group.
Thank you, Ron. And just one final question with regards to new specialized products. Could you elaborate more into what sort of products do you want to enter into? Is it higher voltage products, 700 kV cables, or are we going to more, for example, subsea cables, or what exactly?
Yeah, normal high voltage land cables, specialized extra high voltage as well land cables. Submarine cables is something which you really need a big technology and big investment that absolutely is not in our portfolio. So when we say about expansions for the next year, it will be always about traditional cable, let me say, more competitive and more transmission-oriented land cables and overhead lines, traditional industry, let's say.
This is not to say that we currently don't have active R&D projects for higher voltages and so on, but this is something that's too early to talk about.
All right, clear. Thank you.
Thank you, management team. I think we have another question. Basically, Saud wants some clarification on the guided 25 to 30% net income growth. He's just asking, is this reported net income growth that you're guiding for?
Can you repeat that question, please? There was a lot of background noise.
Sure. So Saud basically is asking for some clarification on the guidance on the 25 to 30% net income growth. He's just making sure that this is reported net income guidance, reported net income growth in terms of guidance.
Yeah, this is the net profit, net income guidance increase compared to previous year. And we said that we will be on the very much upper range of this guidance, so 30% level.
Thank you for that. Maybe one final question from my end. In terms of the acquisition in Uzbekistan, obviously we've seen a lot of activity from regional utility companies, Taka, Masdar, Aqua Power, going into Uzbekistan. So are you trying to leverage your existing relationships with these types of clients in your acquisition? So after you acquire the asset, inshallah, and, are you potentially going to leverage these relationships in getting more business and more volume from that asset?
Look, not absolutely. It's not that we are leveraging on aqua power. There are Mazdars as well. There are other Chinese, etc. But you are right to mention the fact that Saudi Arabia is the second largest investor in the country after the China, and Saudi Arabia is investing dozens of billions of dollars within Uzbekistan. And guess in which sector? Most of this is energy sector. So we are completing and bringing the technology in order to bring the, let's say, full solutions for the development of this energy sector, which is really very strong in the country. And moreover, there is as well big expansions on the residential sector as well. So all the indicators of the countries, especially energy, but as well residential sectors, are in very good position. So we are just complementing, let's say, this kind of investments that, yes, Saudi is doing, and we are Saudi, so we are complementing the investments. But we are not leveraging. It's not that we are having a better preference because Aqua is there or somebody else is there. We need to be competitive. We need to be technological leader, and we need to have the vision and to realize our vision to be a regional leader, cable supply, cable factory leader in the central east region of, so this means Uzbekistan, neighboring countries, and from there as well make it a hub for the export to maybe East Europe and other countries, being very competitive and having the local, let's say, mines, supply chains, and also local support. So I hope, I believe my answer, sorry, is quite clear on this.
Very clear. Thank you, Boyan, very much. We don't have any more hands raised or questions in the Q&A box. So with that, back to you for any closing remarks.